Welcome back. We have spoken all morning about Trump's and tariffs in the US economy, but the market seems to have just recovered from the day's low. So let us now revert to one domestic issue which gave us much relief in early February. The Reserve Bank of India cut risk weights on bank loans to NBFCs and MFIs from 125% to 100%. This was probably because since November 2023, when the risk weights were raised, bank loans to NBFCs have fallen from 30% YOY to 7% YOY as of December. But the Reserve Bank has not cut the risk weight on unsecured loans. So have unsecured loans continued to be a pain point and are not yet out of danger? Also, how has life improved for NBFCs more generally? For all these, I'm joined by Jairam Sridharan, the Managing Director of Piramal Capital and Housing Finance. Good evening to you, Jairam, and thank you very much. Jairam is actually in the United States now and has stayed up for me. Thank you very much, Jairam.
Thank you. It's always a pleasure to be with you.
Well, for starters, you were the one who told us about unsecured loans actually a good 2 years ago. And actually, the Reserve Bank followed, I think, about 3 months later. So I wanted to ask you first about unsecured loans. Your own Piramal balance sheet is quite good in the sense your NS3, GS3, that is gross NPAs and net NPAs are actually declined by a few basis points in your Q3 results. But what is your view of the sector? Are unsecured loans going to continue to give us bad news?
Yeah, the short answer to that is yes, unfortunately. The way the year has gone so far, the financial year, when it started, we were in absolutely the best of health, right? The sector had an absolutely rocking quarter, Q4 last year. But then suddenly, after March, when April happened, things seemed to have deteriorated quite suddenly. Like we didn't quite know what was going on. Operational metrics and unsecured credit were bad in April, and then worse in May, and then even worse in June. And the story just continued all the way through November, almost till December. So there has been many months of deterioration in unsecured credit, and it has been more severe in some product categories like microfinance and a little bit in small business unsecured credit, and a little bit less intense in salaried businesses, in larger ticket businesses, etc. So it has not been the same everywhere. It has been mixed. However, where we are today is that the pain seems to have, from an operating metrics perspective, things have stopped deteriorating. That's pretty much the most that can be said about it. Things are not getting worse anymore. It's been 3-4 months of relative calm, 3 months of relative calm, and things haven't gotten worse. However, by no means can it be said that things are getting better. So it is.
To speak on the I take your point. To speak on the side of things getting better, the government has really started spending well. Up until October, there was practically a drought of government spending, and then in December, it was a 95% increase over a year ago level, their capex spending. January, we again have the data, 50% more. So do you think now loan growth can improve simply because, there is more economic activity? After all, the Q3 GDP came out so much better than Q2. So is there a loan growth possibility?
I think so. I think the growth side of the story had also weakened, unfortunately, over the last 9 months, when the growth rate of overall lending at the sectoral level, which started the year at 20%, ended the year at, or ended December at less than 10% or around 10%. So growth rates have really, really slowed. But now you're absolutely right, Latha, in saying that the government spending makes a big difference. And as the government has started spending, projects have really started taking off. We can see that, that excitement come through. We can see small businesses start to spend a little bit more. And my guess is that you will start seeing loan growth pick up a little bit more from the low levels where it has been over the last couple of months.
Okay, you're in a vantage position to tell us about the real estate cycle. While it has been one of the better factors in the economy, has the cycle been impacted by the wealth effect? After all, we have seen trillions of rupees melt away in market cap. So what's the state of the real estate sector?
Very often when we speak about real estate, we get too carried away by, few real estate players who are listed, right? And their numbers and their public pronouncements, etc. But remember that real estate is a very, very, very fragmented industry. And to get a real sense of what's going on in the sector, you got to look at the entire country, small towns, big towns, everything together. The story there, Latha, is that since COVID, the recovery of the sector has been decidedly K-shaped. The higher end, the more luxury end, has done spectacularly well. Any project that comes out today, which is more than 2 crores, 3 crores ticket size, is just sells like hotcakes, right? In fact, in Mumbai, there are multiple projects with double-digit crores as the average ticket size, and you can't find a spot there. However, you look at the 25 lakhs and below space, and stuff is not selling at all. Things are very, very slow. So it's a very two-paced market right now. The top end is doing extremely well, and the bottom end is actually not doing well at all. And if you look, for example, at the lending business, at the less than 25 lakh loans for housing, you will see that the growth there is negative at the industry level. So that shows you that there is no the small low end is struggling. The guy in the semi-urban and rural markets is really struggling.
Okay. What about then? Let me bring it down to Piramal itself. Piramal Finance, the disbursements in Q3 were 8.7% higher from YOY levels. So, and you of course serve used cars, business loans, salaried. How would your loan growth look like?
We've been blessed. We've continued to have year-on-year growth rates upwards of 30%, 40% actually over the last couple of years. And this quarter is continuing to look strong. So from an AUM perspective, we've continued to feel very good about the growth rates, and we will continue 30% plus growth rates that we've had. Whether it'll continue in the next year is a little bit harder to say, but right now this quarter is looking very strong.
Okay. Now, in your company, of course, you all are running down your old AUM, what you call 1.0, and building up your new loan book. The old DHL book is being run down. When does that process get completed? When will you be not impacted by higher credit costs, very high credit cost actually, because of that legacy part?
Yeah. So we have guided the market that we will end this financial year, that is March, with less than 10% of our AUM being from the legacy book. We are very much on track for that. We ended last quarter at 13%. We should be below 10% by the, over the next few weeks when March ends. Our hope is that by next year end, this number will be significantly south of 5% of our book, and hence will kind of become irrelevant.
Okay. Has life improved for you after the risk weight decline, and what might that do to margins?
Yeah, it's certainly better. Like it's more than the specific risk weight reduction action itself. It's the signaling that makes so much difference. It's a regulator telling the banks that, hey, lending to NBFCs is not a bad thing. I'm not discouraging you. And I do want NBFCs to participate in building the economy as well. That signal goes a very long way. See, specifically when banks are pricing on the basis of RAROC, or risk-adjusted return on capital, a 25 percentage point reduction or a 30 percentage point reduction in capital or risk weights results in about a 25-ish basis points reduction in price, right? So that's basically what mathematically one would expect. But much more so than that, what I'm really happy about is the signal that the regulator has sent, and hopefully that encourages a lot of lenders to step forward and go ahead with lending to NBFCs as they used to do in the early part of last year.
Okay, let me a quick last question. Also, because it's time I allowed you to retire. You've had a long day. Just wanted to know, what would you guide by way of margins now, And what would you guide by way of loan growth for the full year? I mean, this quarter is almost over. For the full year, do growth prospects look good, considering that the global environment is not very clement now?
Yeah, I think for us, idiosyncratically as a company, like our growth prospects are pretty strong. So I feel very good about where we stand. Our core growth book should comfortably grow at about 20%, and on an overall basis, after accounting for the rundown of the other book, we should comfortably grow about 15%. So I feel reasonably okay on the growth front. On the margin front, the sector, NBFC sector overall, has seen margin compression throughout this year. But I think that margin compression story is largely done. Now that RBI has started the process of rate reduction, that will slowly start expanding margins. And that's the way historically it has happened, is that as RBI reduces repo rates, slowly it transmits to sectors like NBFC, and margins start to expand on the other side. That's what I expect to happen in this cycle as well. That should start, I would say, about 4 or 5 months from now as banks start cutting their MCLRs.
Okay, that's good to hear. Jairam, when you're back in India, let's have a longer conversation on the state of the NBFC sector as well. The economy was clearly looking like in a good run, but today's global headlines are casting a bit of a scare. Let's wait and see how things pan out. Thank you very much for staying up for us and for this conversation. As we sign off on Bazaar, the markets have recovered a goodish bit from the morning lows, certainly much better than what the gift Nifty was indicating before markets opened. Positive note as we go into a break and invite Chartbusters team.